Okay, good morning everyone. Thank you very much for coming along to today's event, which as you all know is the launch of Professor Dieter Helm's new book entitled Burnout, the Endgame for Fossil Fuels. Dieter's a great friend of PX. He's written for Policy Exchange in the past. He launched his previous book on natural capital here, in our previous office probably 18 months ago. And he's done many other things. I've known Dieter for a very long time, so we're really pleased to welcome him to come and launch his new book here today. I think Dieter, amongst this audience, probably doesn't need much of an introduction, but given that we're live streaming at this event to hopefully at least hundreds of people around the world, I may as well do an introduction anyway. So. Dieter is one of the leading economists in the UK. He specialises in energy, utilities, infrastructure, but has also covered a number of other really important topics around biodiversity, natural capital. He was appointed chair of the Natural Capital Committee. He's a professor at the University of Oxford, a fellow of New College, Oxford, and a professorial research fellow at the Smith School of Enterprise and the Environment at Oxford as well. And he's actually done many other things, working across Europe, feeding into European Commission's work, and many other held many other sort of academic and other research positions, thinking about the key issues going on in energy right now. Today, for the purposes of this discussion, Dieter will be going through his new book, Burnout, the Endgame for Fossil Fuels, which really kind of tells you what it's about just from the title. I've read most of it, and I've found it. Well, I've read pretty much all of it now on various sessions, and I've found it a very engaging book. It goes through a huge, broad canvas of issues, of the main issues going on in energy right now. In particular, focusing. I don't want to give too much away or steal his thunder, but I like the emphasis on the technological change going on in the energy industry right now and the acceleration of that technological change, and the impact that has in terms of big oil and gas, not only for the big oil producing states and the companies, but also what this means for climate policy and policy makers, not only in the UK, but around the world. So I found it a very engaging read. If you haven't had a chance to read it, you'll hear the highlights, but it is worth grabbing a copy. I think we're selling copies at the end of this and the other books that Dieter has written, which are all very good. Some of this material, some of the concepts around the transformation going on in the power system, the advent of zero marginal cost electricity production and what that means for our markets, for our system, those are some topics which we've also written about quite a lot of Policy Exchange. So there's a report which I'll point you towards called Power 2.0, which we published last year. This is the last known copy of it, so nobody can take it away, but it is downloadable on our website if anybody wants to have a read. But yeah, it covers some of the same issues around technology and the advent of renewables and those sorts of issues. But without any further ado, I'll hand over to Dieter. He'll be giving a presentation for 20 or 30 minutes, and after that we'll hear from a very distinguished and knowledgeable panel of speakers who I'll introduce later on. So, Dieter, over to you.
So, Richard, thank you very much for that extremely kind introduction. Can everyone hear me at the back? Yeah, good, great. So thanks very much for that very kind introduction, and thank you very much to Policy Exchange for giving me the opportunity to set out some of the themes in my book. As Richard said, I've done a great deal of work with Policy Exchange over the years, and this is, if not one of the places where these sorts of issues get debated and discussed. So in the run-up to the election too, looking at what's going to happen afterwards, Richard, I'm sure, will have a key part to play with his colleagues here. So thank you very much indeed. I'm also grateful to Richard because, unlike most book reviewers, or commentators. He's actually read most of the book, or he claims to do so, which is, I've discovered in the last few years, quite a rarity. But thank you. What I would like to do in this 20 minutes or so is to just review the main themes of the book, but I thought that in doing that, what I would try to do is give it a little bit of current context at the beginning and come back to that at the end, because all of you are not only engaged in global markets and the broader energy themes, but by necessity engaged in the nitty-gritty of the energy world, the energy policies, and we will have, I'm sure, a quite substantial shift in the structure and form of energy policy after the election. So I shall try to make it topical in the current context, but mainly my purpose is to draw out the main themes. And with that in mind, I'll start with these immediate challenges. I'll then outline the three big structural changes that I highlight in the book. Of course, there are more, and some will be missed, but I wanted to draw out three big themes around which the book is basically based. So what I try to do in the book is say what these big structural changes are in energy markets, and then the second and third section of the book are second section on what this means for geopolitics, for the big oil producers, for Russia, Saudi, for the United States, and indeed for China. And I try to say what it means for companies, and particularly oil companies and energy companies, electricity and gas utilities, and I also try to say what it means for market design. Now today, because time's short, I'm not going to cover the geopolitical bits, but actually they'll probably turn out to be the most important, and I'm very happy to answer any questions on those aspects of the book. And I'll come at the end and thinking about how you might redesign energy policies if you were the Secretary of State, and for even a nanosecond just entertain the idea that I might be right about some of these things. What would you do? How would it be taken forward? That's going to be very sketchy, but I hope to show that there's an engagement between the general themes I develop and particularly what should happen now and what kind of reforms are consistent with the world I describe and which sort aren't. So just to remind you, and you probably can't even read this slide at the back, and it doesn't kind of matter, okay? It's a slide which just lists up just some of the many debates and controversies currently going on across the energy sector. Years ago, I asked someone in my office to produce a slide and write on one page all the new government interventions since, at that stage, about 2008, into the energy market. And I used to call it the optician slide, because for those of you who have had tests for glasses in your eyes, etc., you know when it's put at the back of the room and you have to read it and you try and double guess what the answers are as you go down. My optician slide was so dense that you couldn't read any of it at the distance an optician slide would have been put. We've got all sorts of stuff going on. The immediate issue is about smart meters, about standard variable tariffs, about pricing, about embedded generation, about how the capacity auction should be done, what should happen to subsequent nuclear, what future capacity auctions we should have, what the transmission and distribution reviews would look like, what smart meters framework will eventually look like, what the coal closure program should be, how the FIT auctions should be worked. It's just massive detail, and that's just domestically. We've got the whole Trump phenomena, we've got loads of stuff happening on the international side, the sale of Aramco's shares, the Arctic drilling in Russia, etc., etc. So there's a huge amount going on. And what I try to do in the book is stand back from this cacophony of developments and ask what are the main structural things that are shaping the energy market within which these policy questions should be addressed. And I basically identify three. One, and it drives all the way through the book, is the end of the commodity supercycle, the fall of oil prices, and my view that the oil price will carry on falling probably forever. And the view that $50 is a very high price for oil, not a low price for oil. And the view that although there might be spikes, the price might be 100 tomorrow. As I say at the first line of the book, when you read this book, the price may be 200 or 20. That's not the point. The point in my book is what is the direction of change? And I'm going to point out in a second how radically different that assumption is to almost all the fundamental inputs to the design of current energy policies in Britain, in Europe, and actually to an extent in the United States, focused on peak oil, rising prices, and the assumption that alternative technologies would be priced in the market because oil and gas in particular would become so expensive that Ed Davies' high and volatile gas prices, which we were going to escape from. I was lambasted in the FT and the letters column in 2011 because I was stupid enough to suggest that gas prices might come down as opposed to go up, and that we should for suggesting that it wasn't worth buying the insurance against volatile gas prices as the motive for policy. So my view on the oil prices and the direction of travel is radically different from the conventional wisdom as up to 2014 and behind most of what people were doing before 2014 in markets, but it also has radical implications for the oil producers and the companies going forward if my explanation of the world turns out to be correct. May not, of course, but I ask you to enter the thought experiment that I might be right and then work out what you think would happen if my view of the world turned out to be correct. At least that thought experiment should be conducted. So my first structural change is about oil prices, which I'll come to. The second one is decarbonisation. I regard it as unstoppable. That doesn't mean I'm not highly critical of many of the decarbonisation policies we've adopted. Occasionally I flippantly remark, and it's of course not quite true, that the approach to climate change has been to try to think of the most expensive things to do first and then spend the subsequent years trying to find something even more expensive than you thought about in the first place. We have spent a lot of money on addressing climate change, and as you'll see when I develop my third theme, my third change, we could do better, and indeed we have to, because we're not globally making enough progress on climate change yet. And that's my third change, which is the radical technical change that's taking place. And I start not with trying to predict what energy technology will work. I start with what's going to happen to our economies more generally. So a big theme in my book is what the digitalization of our economy means for the demand for energy and therefore feeding through to the supply of energy. So it's about oil prices and the end of the commodity cycle, decarbonisation, and it's about new technologies. And the rest of the book is what it means if you buy my three structural changes. So think about it, if you don't agree with the component parts, think about it as a thought experiment. And I ask you to engage in that thought experiment to help formulate better policy, better industrial strategies, and hopefully a better environment for us. So this slide, which I think is one of the best slides and most interesting slides that you can look at when you look at the oil industry, is the slide that BP has been producing for years in their, I don't know what it's called, the Energy Outlook, or it comes out each year. And other oil companies produce these things. But this slide is oil prices in real terms since 1860. Okay? So this is the 150 or so years, or slightly more years, of the history of the oil industry. And this shows you the price. And the first thing to note, which is really interesting, is that for 100 years, from 1870 to 1970, despite the transformation of our world from 2 billion people eventually up to 6-7 billion people and beyond, the entire industrialization process, which was overwhelmingly based on fossil fuels, the demand kept going up and the price actually fell in real terms. So those people who say, oh, we predicted all this demand out there in the future, hey presto, the price is going to go up, well, for 100 years it didn't. In fact, the opposite happened. Now, the world wars don't even show up on that diagram. There's a reason for that, rationing and direct controls, etc., etc. But it's a long period. We look at the world as if this is normal, as if these two very short price spikes in the history of the oil industry are the normal, and at the end of each spike, the forecast by policymakers was that is going to happen, and then that is going to happen. And when people argued in Europe and elsewhere that we ought to go down a crash course in renewables, there were, by the way, good arguments for doing that and bad arguments. Okay? One of the key arguments used in the public debate was that, of course, this was an industrial project because by 2020, the oil and gas price would have gone up so high, be high and volatile, that consumers will be better off because even though things like offshore wind and solar and onshore wind, whose costs would fall, would still be expensive, they wouldn't be anything like as expensive as these fossil fuels by that stage. Now, if you go back, and I do in the book, to 1979, you'll find exactly the same stuff. But that time around, it was the reason for building 58 nuclear reactors in France and 10 nuclear reactors announced in the House of Commons in 1980-81 in the Mrs. Thatcher's government. Because they knew the oil price was going to be high, and therefore the future was non-oil technologies. Now, I say these are very short. They are actually very short. This spike is only about 5 years. And this spike here is similarly only about 5 years. And what I describe in the book is how the market reacts to price movements, why supply and demand works in the energy market, and in addition, why the idea we were going to run out of fossil fuels, the peak oil notion, is nonsense. Now, I spent a lot of my career arguing that peak oil was nonsense, and although everyone says, oh, that's an old canard, everyone knows that's rubbish now, I go through the quotes. That's what they argued. I remember going to the Foreign Office in about 2011 to a session with 50 people, and I realised I was the only person in the room who thought peak oil was nonsense. My line in the book is essentially there's more than enough oil and gas, even worse coal, to fry the planet many times over. Whether the reserve's going to last for 200 years or 100 years or 150 years, it's irrelevant. It's just too long. I mean, you should never think that supply isn't going to respond, and you should never think that the technology is not going to respond too. And people think that technical progress always just happens in renewables, and they predict down the cost falls, and there have been significant cost falls. But they never assume the same thing about the fossil fuels, right? And that's where most of the R&D work goes in terms of aggregate. So when the price fell, after this particular episode, down to $50. First of all, everybody predicted it was going to keep going back up and it was temporary. And I quote the oil companies and the various ministers, etc., saying how the price was going to go back up to 60, 70, 80 relatively quickly. But when they look at this, they made some really key strategic mistakes in thinking that this was temporary. First of all, they didn't understand that supply increases as the price falls. If you're running an autocratic, oil-producing, oil-cursed regime, and you were relying on $100 a barrel to balance your budget, and suddenly it's 60 or 50, do you A, say, oh dear, I'm keeping the oil in the ground now, we're going to get the price back up? Or do you say, my goodness, I've got a rebellious population on my hands, I need the money, so if the marginal cost is $10 or $20 a barrel, it's still extremely profitable, I pump. And so conventional oil production increased in this bit here, particularly Iraq, by the way, but Iran and Iraq are a big part of this equation. The second thing is they assumed that shale will be out of the market at $70, $80, as if, the second point, costs aren't correlated with price. So as the price goes up, the costs go up. You went to Alberta, you would have seen that in the tar sand boom. As the price comes down, the costs fall. The cost of labour, the cost of steel, even the cost of pizzas in the oil-producing areas. And so now $50 seems to be perfectly plausible for shale to continue in that frame. And I discuss in the book how this pans out more generally. Now, just to show we do some detail in the book, these are, we did an analysis looking back of the IEA forecasts, or projections, they say, right back into the 70s, in fact, to see whether, since everyone seems to believe the IEA forecasts or use them as a reference, whether they're any good. The answer is they're not. Okay? They systematically bias on the upside in aggregate, and that's exactly what you think an organisation whose budget depends on security concern would focus upon. No criticism of them at all, but it's exactly what you'd expect. We show that the value in the forecast is less than the value in the spot price at any point during the process. So next time you read the IEA forecast this or that, take a rain check and ask yourself why and what model are they using. And I argue in the book extensively about why we need to think about modelling in a new way. These are some just quotes in the book of what people said about how the price was going to go back up after that fall from 214. Now that's the first one, and I trace through in the book what that means if you buy that story, and I do explain why I think that story about oil prices at $50 being high and falling through time, what it means. Now the second big structural change is clearly decarbonisation. You can argue that not much has happened yet. You know, if you go back to what people wanted to happen in 1990 and the Framework Convention and what's happened, this is not an unmitigated success. And it's no accident that the projections in the oil companies' outlooks, their annual studies, show an oil burn, and indeed a gas and coal burn, which are inconsistent with holding emissions somewhere around the 400, 450 and keeping to the 2 degrees. We are not on the path, okay? But I'm clear in the book as to why, since climate change won't go away, right, why that continued clock away at decarbonisation will remain a force. And contrary to what you might read out of this stuff, pessimism, I'm actually quite optimistic about how we crack this, but not in the conventional way. So this comes to my third structural theme, which is about technology. Now, this is, to many environmentalists, a very controversial statement, but I think it's patently obvious. We will not solve climate change on the existing technologies. So, if you say, oh, you're just a technocrat who thinks that technology is going to solve everything, but I don't think technology is going to solve everything, but I do think it's a bet that we have no option but to pursue. And indeed, the costs of R&D and the costs of developing next generation technologies are actually pretty low compared with the costs of deploying existing technologies, some of them very expensive. No criticism of particular projects, but if you're going to spend 20 billion on a twin nuclear reactor, and you think what you would do with 20 billion on solar research, if you're going to spend the sorts of sums that are spent on offshore wind, in total, what would happen if you spent a bit less and you spent it on R&D, given there's a limit to people's budgets as to what they're willing to spend? I think that's a reasonable debate to have. And I'm just baffled by why people think that this is kind of to be ruled out. Now, on the technical change side, the themes that I pick out, the ones I think are really important, start with digitalization. I don't start with which particular energy technology. So what we've got going around us, and this isn't picking winners, this is just describing what's actually happening. You have the possibility of applying robotics across nearly any activity in an economy, almost any. They may even actually, contrary to what people say, be capable of cutting your hair, but that's an aside. But you see it in manufacturing in large scale. If you go to a major car firm, a new firm now, a new plant, you'll notice it's A, silent, and there aren't many people. Robots are in the house, they're more general. Now, robots are part of artificial intelligence, and that's the other of the three, the second of the three, really big change that's taking place. So artificial intelligence does a lot of things that you already don't know about. You may read sports reports in particularly American newspapers which were written by in artificial intelligence, not by people. Whole swathes of activity from due diligence, law activities, banking, etc. are amenable to artificial intelligence. And the third one is 3D printing, basically additive manufacturing. The idea that instead of what we've done in the 20th century, which is done mass production where there's cheap labour, we might do bespoke manufacturing close to final demand without labour, because this is how the three things interact. It's the robotic side of that too. That changes, not everything, but that changes the game. For example, why would you put a car firm in China if you could have it in America, if the labour costs don't matter anymore? These are quite dramatic changes. They change the distribution of the demand for energy and the form. Now, the point I make here is, A, and this is a simplification, and I'm a bit more subtle about it, I hope, in the book. Everything that's digital is electric. Therefore, the future of energy is going to be much more about electricity than it has been in the past. It's not quite everything is digital everything digital is electric, therefore everything's electric. That's too simple. But the general trend tells you that if you want to address climate change in particular, but if you want to address energy security, energy policy, it's electricity you should start with now, not oil. And remember, oil's market is transport and petrochemicals. The petrochemicals are vulnerable to gas substitution from oil, and of course the transport side is vulnerable to all these technologies. That's the technology bit that matters. Now we come to the generation technologies. There are only 4 ways of doing low carbon. If we want to decarbonise and do this digitalisation, and by the way, do it secure, because digitalisation will require much, much more security of supply than the current systems we have. So you can do it through nuclear power, in theory. But I doubt anyone in this room thinks we're going to build several hundred, maybe several thousand big nuclear reactors in the next 20 or 30 years. Okay, we're struggling to build 1 or more in Britain, and many other countries have given up. And as they did actually in the 1980s when the oil price fell then. Okay? But when the oil price fell in the 1980s, A, it did for the Soviet Union, but B, it did for nuclear power here and in many other countries too. So you have to think that through. That's not going to work. Gravity, well, there's a lot of gravity potential power, tidal and particularly hydro, but a lot of the hydro, the best stuff's been done, and a lot of the future hydro is quite questionable from an environmental point of view. Maybe it's got more possibility on the small scale and the large scale, but we need a hell of a lot of energy to do this. The third option is geothermal, and potentially it could really help on the heating side in particular. But you know, it's located where volcanoes and cracks in the earth crust tend to be, places like Iceland, so it really requires other technologies as well, like transmission and so on. Which brings you back to solar. And again, I've always been critical of picking winners, but you have to say, if you look at these alternatives and you want to decarbonise, the broad solar box is where you would want to chuck some R&D money, if I could put it in the most simplest way. Okay? And why? And when I say solar, I think of wind as being solar essentially, but I'm mainly focused on direct capture of solar energy and turning it into electricity. Now, why? Well, first of all, it's effectively infinite. Right? You can power a globe with 10 or 12 billion people with the energy from the sun if you could harness it. Okay? So the idea you want to reduce energy demand in a solar world is nonsense. It may be too cheap to measure. It's certainly very abundant. Okay? Our problem is we can't efficiently translate that abundant energy. 1 hour sunlight is worth the entire electricity production for a year currently, so from that point of view it is effectively infinite as supply. We can't harness it. But the 2 promising lines, and these aren't picking winners, this is saying what's going on in research, is A, opening up the light spectrum. We've got beyond the real inefficiencies of photosynthesis, which is incredibly inefficient, but opening up the rest of the light spectrum. That's a science question, which needs science budgets to deliver. We have to be able to do that if we're to have enough low carbon solar energy to make a difference to climate change. The second thing you have to do is work on the ways of translating what you've captured from that light spectrum to actual energy. And in that area, there are a huge number of exciting things going on. The costs of conventional solar have fallen substantially, although despite all the claims that these things are grid competitive, etc., when you really take the system costs of these things into account, and a point which actually Michael made correctly in criticising me, especially when you take into winter in the Northern Hemisphere, etc., to account, we've got quite a long way to go, and that's ancillary technologies like batteries and storage and all those things that are coming. But the real issue is whether we can develop some form of solar film or some form of solar application which can be widely applied to virtually everything. Now, I'm not a scientist. I don't know whether that's going to work, but when I talk to the scientific community, that's what they seem to be really interested in. I'd throw $1 billion at that rather than 10 billion offshore any day if that's what I was interested in serious climate change policy. It doesn't mean you shouldn't do some offshore, it simply means it's the relative balance of these things that matters. So applications and opening up the light spectrum open up this potential to take forward. And that then combines the change of the technologies in electricity generation, and I've focused on electricity, and the broader transformation. Now you may say this is going to be slower, it's overhyped, it's not really going to happen, but if you go into any local community and you meet people who've lost their jobs because effectively they're no longer there, these people care about this. This is why people talk about basic income, they talk about the social consequences. People are beginning to understand that these things are massive changes. I'm interested in what it does over here, and I'm interested in how it cuts into the demand for fossil fuels and how it drives down the price of renewables and therefore feeds through the climate change story. So those are my three big structural changes. The second part of the book is all about what it means for the Saudi Arabias, the Americas, the Russias, the Chinas, etc. And it's very bleak about the Middle East. It's very bleak about Saudi Arabia. It's very bullish about the United States. Trump, I finished the book just before the election, but you'll see the election, the book is not dependent on whether Clinton or Trump wins. But Trump is a very lucky president in the energy terms. He arrives after Obama presided over the largest increase in fossil fuels that America has seen since the Second World War. Obama is the fossil fuel president. Cut the rhetoric, that's what he presided over. America is really on course to having rough energy independence. It has abundant gas. It can reshore the petrochemical industry. The digital technologies will bring back companies anyway because of the no longer they need the cheap labour overseas because the digitalisation and the robotics cut into that. And he's got exports. And remember, the US trade deficit, half of it used to be oil. So this is a very different world going forward. So I talk about in the second part. Happy to take some questions. But just to finish up this very short presentation, let me just trace through some of the implications for the companies and then end up with some policy points. So we have a lot of stuff going on amongst NGOs about how all the oil companies' assets are stranded and how investors should start disinvesting from these companies because the stuff isn't going to be worth burning in 50 years' time or whatever. I mean, I understand the argument, but investors have discount rates, right? And the discount rate tells you that what matters for an investor, and will go on in mattering for investors, is what happens in the next 10 years. Okay? If you've got a discount rate of 10% to the earnings of these companies, anything after 10 years doesn't really matter from an investor perspective. Okay? A much more interesting question from an investor's point of view is what should the companies do as a profit maximizing strategy if you believe my view about oil prices? If. Okay? And the answer to this question is that the implications for the strategies could be very profitable. I mean, after all, tobacco companies are very profitable. Declining industry companies can be extremely lucrative investments for people to make. But there's certain things that happen. Once you realise that a barrel of oil tomorrow might be worth less than a barrel today, first of all, if you're Saudi Arabia, you pump even more because now it's really expensive to hold back production because you're going to get less money tomorrow than you get today. Okay? But similarly for the oil reserves, it's absolutely true, and this is where the stranded asset people get one bit right, is the value of the proven reserves on the balance sheets is less on my world than it otherwise would have been. That's why the share prices have crashed. Right? It's not stranded assets, it's just revaluation. If the oil price went up tomorrow, then the value of those proven reserves will go up on the balance sheet, and people would not say, this is the opposite of stranded assets, go and invest in oil companies. Right? This is a one particular way route. Okay? But what you would do is you'd realise that the concentration of oil production is going to go towards the lower cost production. And that's the odd thing about oil. I mean, there are very few markets where the marginal cost is 10 or even 20 in Russia. Okay? And there's buckets of the stuff available, and people produce the stuff at 70. Right? And as you move towards what I call the long end game of oil, the incentives to move back to the marginal cost production increase. So if you think that it's a great idea to go drilling in the Arctic, right? If you think that you really should invest in deep offshore, the big capital intensive projects, if I was an investor in your company, I would say, why are you doing that? Right? You know, the cost function's coming down, you come down the cost function, and be reasonable to the companies. That's what they've been doing, coming down the cost function, with some exceptions. If you believe it's going to go back up, hey, let's take a punt on it. You know? But in my world, just imagine it doesn't. You'd also see that it doesn't make sense to borrow to pay the dividends. Right? It only makes sense to borrow to pay the dividends if you think that tomorrow the price is going to go back up and this is a temporary problem and we can bail out the investors in the intermediate period. Okay? But big oil companies are ungeared or lowly geared for good economic reasons. They're equity bets on technology and future oil prices. So you'd cut out the capex. What you'd do is you would harvest an exit. That would be an extremely profitable strategy to pursue if you take my particular view, okay, and concentrate on the low production, okay? You would pay high dividends because you'd pay the cash out to the investors, not invest it in new capital investment in the oil and gas industry. And you would, in the result, minimise your capex at the margins. That is not yet what's going on across the board, but if I'm right, those three things will come to bind and they'll home in on the companies. Now, if we look at the electricity companies, again, I go in much more detail on electricity than I do in oil, and that's odd for a book that's got a lot about oil in it, but I want the oil industry to think about electric. Think electric if you want to think about the future of oil, okay? These new robotic technologies, AI, 3D printing, and indeed the new renewable technologies are all zero marginal cost. Right? Now, the radical implication of that is, while we have a whole load of people running around saying how wonderful it would be to have a really competitive electricity supply market, actually, this market is going to be passing through fixed costs. Right? It's like broadband. Right? You may pay a volume price for broadband, but you don't actually have a marginal cost for broadband. You buy a chunk of capacity. The electricity market in the world I'm describing is a capacity world, not a wholesale variable cost world. Yet the entire structure of the electricity industry and almost all the policy is based upon the idea that what really matters is the wholesale price. Okay? It doesn't as we go forward. It won't go to zero. It still balances the market, but it becomes less and less important. I'll come back to that. And a fixed price capacity world is the securitization utility world. And already the big infrastructure funds, the pension funds have understood that's what wind farms are when they're completed. They're a securitization of a fixed price FIT contract. But everything is a securitization of a fixed price contract. It's a regulatory asset base. It's just called a FIT guarantee of revenue rather than a RAB guarantee of revenue from a utility. So this is a very different financial model. And vertical integration has no sense in this model whatsoever. Okay? So just like the oil companies, the strategies may have worked in the past, but if you buy my world of the three structural changes, the big six here, they've already done it in large measure, break themselves up. They divest of components, and you get lots of new entrants coming into the market. And just to push that point forward close to conclusion on the market design, this is an economics of internet and broadband. And it will be those players who deal with the supply end of the market. I think it's be very, in 5-10 years' time, be very quaint, the idea you just sell electricity or you just sell electricity and gas. It'll be the broadband hubs that matter. But it has radical effects in Europe too. When I was at the Commission, I tried to explain in 2011 that capacity markets were really important to be thought through from a consistent, competitive basis for Europe as a whole. No, I was told the internal energy market's all about variable costs and variable prices. I disagree. I think this really needs to be thought of the new internal capacity energy markets. And it may be too late in the game. And they're very late on the attempt to think about not regulation in terms of price regulation, but the rules of competitive markets for these things. And I think broadband hubs come. So it's all about new companies. Right? It's not that the existing companies won't be profitable. It's just realizing the game's changed. And the parallel I draw is the parallel with what happened in communications. When I started out, AT&T was where it was at. The state-owned British Telecoms was where it was at. The big, fixed line, historic companies that developed from the Second World War onwards dominated everything, and IBM dominated the background of big computers. There were no Googles, no Facebooks, no Amazons, none of these players were on the pitch. So the most likely players on this pitch in 10, 15, 20 years' time are companies you've never heard of. But we can already think about lots of people channeling around the margin. If I was Amazon, I don't know how their business model works, but here's a proposition. You're going to multiple sell into household via the broadband hub. Why do you need a margin of more than 0.1% on electricity? Think what that would mean in the current world. That's why I propose a unregulated but published margin as the basis of energy price reform in Britain to, in part, help draw this in. So that brings me to my last slide and my 30 minutes conclusion. So we've got lots of decisions to make. And again, you probably can't read these from the back. It's the same principle as the optician slide at the beginning. And this isn't in the book. But if you work through each of the issues that we confront in the energy sector, you can work out the policy implications now of the themes that I developed in the book. So the argument is, if you believe my 3 structural changes are really significant, if you buy my point about zero marginal cost and capacity markets, then take any of the particular problems we've got at the moment and think them through. And in every case, think R&D, which is very important to this frame. So my conclusions are that 214 is a substantial structural break in energy markets. And we should not think of those 2 peaks as the normal. We should think of them as historical exceptions. Decarbonisation is unstoppable. Technology is what's going to drive us through on the decarbonisation process. The top level agreements like Paris, whether they're good or bad, and you can argue either way on the things, that's not actually going to solve the problem, and nobody thinks they're actually going to solve the problem. They might help to enable them. I'm sceptical, but other people have different views. Zero marginal cost is something you should think about in energy markets all the time, and you should think about new entrants. You should think about this digital and electric world, and that means that you should fundamentally rethink a set of energy and environmental and climate change policies which were built around peak oil, ever rising oil prices, existing decarbonisation strategies, and on existing, not digital technologies. Thank you very much indeed.